the recent sharp price decline we saw in precious metals, it was not a spontaneous liquidation event. To interpret it as simple profit-taking is to fundamentally misdiagnose a structural maneuver. The speed and the coordination of the selling suggests a much more deliberate dynamic is at work here, one that you really can't understand by just looking at price action in isolation. So this analysis, what we're going to do is deconstruct the technical nature of the event, place it within the context of some very severe central bank constraints, and then outline the scenarios that emerge when you introduce a significant political variable. We're going to examine this sequence not as some random market fluctuation, but as a potential prelude.
Our central thesis is this. What we just witnessed was not a fundamental rejection of the asset class. Not at all. It was a deliberate, technical maneuver, and it was designed to clear out the leveraged participants and completely reset market positioning, all ahead of a significant, and I believe, anticipated policy shift. Now that distinction is critical. Think about it. Profit-taking is a final action. It marks the end of a thesis for a market participant. Repositioning, on the other hand, is preparatory. It is a strategic clearing of the field before a new phase of engagement begins. And understanding this difference is absolutely essential to correctly interpreting the events that are likely to follow.
Our analysis is going to proceed across 4 sections. First, we'll start with the market anomaly itself. Then, we're going to examine the central bank constraint. From there, we'll introduce the political variable. And finally, we will outline the forward scenarios and the key indicators that we believe require monitoring.
All right, Section 1, Analysis of the Market Anomaly. To really understand the strategic implications of this event, we first have to deconstruct its technical sequence. This lets us differentiate between a structural purge of weak leverage and a genuine change in the fundamental long-term thesis for holding monetary assets outside the fiat system.
The execution of the price decline itself, it really warrants a close examination. The velocity, the precision, it suggests an engineered process, not some organic, panic-driven cascade. It really had all the hallmarks of a controlled demolition. So, to understand how an event like this was even possible, we first have to analyze the structural vulnerabilities that existed in the market right before it happened. You see, the conditions for the decline were cultivated long before the first significant sell order was ever placed.
The environment before the decline was, to put it simply, structurally fragile. The long precious metals trade had become extremely crowded with heavily leveraged capital, especially from hedge funds and those retail-facing ETFs. This concentration of leverage created a very precarious market structure. When too many participants are all positioned in the same direction with borrowed capital, the market itself becomes inherently unstable. It creates a structural demand for liquidity that can then be exploited, making the entire edifice vulnerable to a cascade of forced liquidations, triggered by a comparatively small catalyst.
The cascade itself was executed with precision. First, pressure was applied to silver. That's the market's weakest point, given its smaller size and high component of speculative leverage. As silver's price structure fractured, a more controlled, almost surgical decline was initiated in gold. Now, the breach of key technical levels in both markets, that activated the algorithmic selling programs, triggering a pre-programmed wave of stop losses and margin calls. This all culminated in a final, non-discretionary purge of leveraged institutional capital, as funds were simply forced to liquidate to meet their obligations. The cycle was completed by design.
So this sequence, it really confirms the technical nature of the event. It was not driven by some sudden shift in the fundamental outlook for inflation or sovereign debt or geopolitical risk. No, this was a structural event, triggered by an exploitation of market leverage. The objective was a purge of weak capital and the transfer of assets, not a fundamental rejection of the core thesis. And this distinction is paramount as we broaden our aperture to the macroeconomic context.
Section 2. The Central Bank Constraint. You see, the events in precious metals cannot be analyzed in a vacuum. They intersect directly and critically with the binding constraints now facing the Federal Reserve. The central bank is no longer operating with a full range of policy tools. It is navigating a series of intractable dilemmas.
The Federal Reserve is operating with a profound conflict between its public mandate and the systemic reality on the ground. Its stated objective is to control inflation. The reality, however, is a system burdened with record levels of sovereign debt. The banking sector's collateral base is inextricably linked to the value of that debt. So aggressive monetary tightening to fight inflation would directly impair that collateral, risking a systemic crisis. And given the political sensitivities of an election cycle, such a move is just not a viable option. The Fed is therefore cornered. It cannot fight inflation without breaking the financial system, and it cannot save the system without accepting higher inflation.
Given these constraints, the central bank is forced to rely on what we can term hawkish posturing.
This is a communication strategy, really. It's designed to manage inflation expectations through rhetoric, precisely because the systemic capacity for substantive action is so limited. It's a necessary tool when your traditional policy options are exhausted. The goal is to project an image of control and a willingness to act, hoping that the market's belief is enough to temper inflationary behavior without requiring the destabilizing actions themselves.
So from a policy perspective, the decline in precious metals was strategically convenient. It served to temporarily suppress market-based inflation expectations, as gold is a primary indicator of that. It provided a form of controlled asset deflation, which releases systemic pressure without it spilling over into broader equity or credit markets. And most importantly, this creates critical policy breathing room. It allows the Federal Reserve to maintain its hawkish communication strategy without being immediately forced to implement those destabilizing rate hikes.
This brings us to the third component of our analysis. The already fragile equilibrium between monetary policy and systemic risk is now subject to an exogenous political variable, one with the potential to act as a powerful accelerant.
Section 3. The political variable. We're now going to consider the potential for direct political objectives to influence monetary policy. Now, this is a factor with significant historical precedent, yet it appears to be underpriced by the market, which, for the most part, continues to operate under the assumption of complete central bank independence. A potential incoming political administration has publicly stated economic objectives that run in direct opposition to the central bank's current posture. These objectives include pursuing a competitively weaker U.S. dollar to favor exports, engineering lower interest rates to support domestic manufacturing and service the national debt, and an explicit willingness to apply direct political pressure on the Federal Reserve to achieve these goals. This represents a direct challenge to the existing policy framework.
The historical record is quite clear on this point. Periods where you see overt political pressure applied to a central bank, one that is already constrained by systemic fragility, have often coincided with significant, nonlinear upward repricing events in precious metals. In this context, gold acts as a barometer of declining confidence in the independence and ultimately the efficacy of monetary policy itself. It essentially reprices the risk of policy being subordinated to political ends.
So if you view it through this political lens, the recent market action can be interpreted as a tactical repositioning in anticipation of this future catalyst. The first step was the flush out of leverage capital. This engineered decline created the liquidity that's required for patient institutional capital to establish or increase their core positions at more favorable price levels. And the final step is a reset of market sentiment, shifting from widespread euphoria to fear and uncertainty, thereby preparing the foundation for the next major secular trend.
Section 4. Forward scenarios. So having established the mechanics of the event, the systemic constraints, and the political variable, we now turn to the path forward. We're going to outline a potential market phasing and identify the key indicators to monitor for confirmation of our thesis.
The path forward is unlikely to be a straight line. First, we anticipate a period of continued volatility and price discovery, which is really designed to exhaust both bulls and bears and discourage any premature positioning. The critical signal for the next phase will be a discernible pivot in Federal Reserve communication, a move away from its hawkish posture towards something more neutral or even dovish. This pivot will likely precede the return of institutional capital, which we'll be able to see in sustained ETF inflows. The final phase would then be a significant repricing event, as the market rapidly internalizes the new policy regime.
Within this scenario, it's really important to understand the distinct roles of gold and silver. Gold serves as the foundational, lower volatility asset. It typically leads the initial move as large, risk-averse capital seeks safety. Silver, with its smaller market size and higher speculative composition, it functions as a high beta expression of the very same thesis. It historically underperforms in the early stages, before significantly outperforming gold once the new trend is firmly established and confirmed. The recent, more severe decline in silver is actually quite consistent with this historical pattern of behavior.
Now, confirmation of this thesis will depend on a matrix of key indicators. We'll be monitoring for a rejection of the US dollar index from its recent highs that would signal easing financial conditions. We'll look for a definitive peak and subsequent decline in bond yields, signaling a structural shift in interest rate expectations. The primary catalyst, however, will be a palpable shift in the tone of Federal Reserve communications. And finally, sustained and significant inflows into precious metals ETFs will confirm the return of that institutional capital.
It is critical, however, to note that confirmation is a lagging phenomenon. By the time these indicators all align to provide a clear and unambiguous signal to the consensus, a substantial portion of the repricing will have likely already occurred. Confirmation is the market's reward for consensus. It is not available to those who must position ahead of it.
The price of certainty is a lower return.
So we conclude not with a price prediction, but with the central strategic question this analysis presents. Given the completed technical washout, the binding constraints on the central bank, and a credible political catalyst for a forced policy pivot, the primary market asymmetry becomes clear. The question for portfolio allocation is this: is the greater risk a further nominal price decline from these cleared levels, or is it the failure to be adequately positioned for a fundamental repricing of monetary assets themselves?